So 13a is about introducing probabilistic risk models for us. In general, the idea here is that we're trying to use probability and statistics to get better modeling of the risks of our cash flows and our discount rates. So if we take a simple two cash flow bond example, say cash flow 2 is, in this case, estimated to follow a Bernoulli distribution. That's a yes-no distribution, distributed something like this, a 90% probability that we're going to get the as-promised cash flow 2 of 100, and a 10% probability that we're going to get 0 if the managers of the company screw up, right? And so this would give us an expected value return if we repeated this experiment many, many times of 90. But if we use the whole Bernoulli distribution to model the risks of this bonds, we can say more to our clients than we've been able to before. Previously, we've been able to say something like our best guess is that on average, if we do buy a lot of bonds like this, on average, we're going to get $90 a bond. But now, knowing the whole probability distribution, we can also say, and we're going to sound oh so smart, this is based on our view that about 90 out of 100 of these projects will pay their promised cash flows, contractual cash flows of 100, but we think about 10% of them are going to flame out. And when that happens, in bankruptcy, we're going to get a cash flow to of 0. So you see, doing this, thinking about the whole probability distribution, it just gives us oh so much more to say, and honestly, oh so much more to know about what's happening. So how did we do this? We're still using our point statistic, which is our expected value. We'll think of this as our general case reward. So our point statistic will be expected value, general case reward, and we're going to be always using the spread of our probability distributions to measure risk. And with a Bernoulli distribution, the spread is just the worst possible outcome and the best possible outcome. So we need to think a little bit about cash flows versus returns here. And if we're looking at any project with future cash flows, so let's say we have a cash flow here at t equals 0 and a future cash flow here at time t equal 1. Cash flow 1 is clearly a random variable. It's out in the future. It hasn't happened yet. It may or may not happen in part or in full. So we're going to measure that with a probability distribution, Bernoulli or normal or otherwise. Also, we're going to be looking at, in just a second here, returns for projects, and returns are defined in one of two ways. If we're talking all cash flows all the time, cash flow 1 minus cash flow 0 divided by cash flow 0, and since cash flow 1 is a random variables in, random variables out, return is going to be a random variable too. Also, a lot of times, if we are stock investors or something like that, and we want to think about what's our return of owning the spiders after a year, we estimate the price of the spiders in a year, whether or not we're going to sell. We just sort of pretend we're going to sell at the price we anticipate in a year, minus the price today divided by price today. And since price in the year ahead hasn't happened yet, that's in the future, that's a random variable, so the return is still a random variable. So we need to be able to think about future cash flows and returns as random variables with probability distributions. And we spent some time going over modeling the reward and risk of stock returns. This example I've included, again, because it's extremely important. So let's just go through it, because conceptually, this is really foundational. So we've got here the project is to buy 1 share of the spiders, hold for a year, and sell. And what we're interested in is how to characterize the returns for this project probabilistically and statistically in terms of reward and risk. And return is going to be, for this project, price a year out minus price now, quantity divided by price now. How did we go about doing that? Well, we started by looking at history, and we do this a lot. It's not great, but it's what we have, and so it's very common. And so I got a bunch of end-of-year closing prices of the spiders. These are available. You can pick these up very easily. These are at Yahoo Finance, Bloomberg, Google Finance, etc. And from the prices, I computed an annual return for each year. So now I have a big list of returns. And then you want to do a probabilistic statistical analysis on this return data. And this is something you want to do with any statistical probabilistic problem that you have. First thing you really want to do is create a frequency distribution of your data and just see what that looks like. So this is actually real data, and this is what it looks like. And what we typically say in a case like this is that, well, you know what, it's got a central tendency here somewhere around the mean. It's spreading out this way, spreading out this way. It's sort of kind of symmetric. So we say, hey, it's got shape of normal distribution, okay? And so that's step number one. And then step number two is you always want to compute some key statistics for your sample data. Always want to get your average return. And when we're talking about sample data, that's X bar. So I did that for the above data. It's 8%. Standard deviation of the sample data, that's always called capital S, was 25% there. Okay. But now with this assumption saying, hey, yeah, this kind of looks like normal, and these sample statistics, we can make a huge jump. Okay. And that's what we do. We say that on the one hand, the future of the spiders is going to look like the past. And on the other hand, we'll say since that sample data looked kind of normally distributed, we'll say we can model it with the normal density function. And so we morph our sample expected value into the expected value of the normal distribution, and same thing with the standard deviation of returns. And so we've gone from something, our real data, the truth and nothing, the whole truth and nothing but the truth, to this, okay, which is our normal distribution model. And to get there, we had to say, first of all, well, future returns, if we get a whole bunch of future returns, they're going to look like these past returns. And then we had to say, this looks normal, and we can morph this sample expected value and standard deviation into the same statistics for the normal distribution. So that's everything that's behind so much of what we do in finance when we're looking at returns of stocks and things like that. So the two big implications of this is that we're measuring reward by expected value still here. We're saying we characterize reward by, on average, over the long haul, we expect the spiders to return about 8% annually. But now we're also, very importantly, talking about risk, and risk is always going to be measured in some way by the spread of that distribution here, okay? So if we have something like a treasury, we assume the federal government never goes bankrupt. Our treasury return has no spread, okay? Basically what the treasury promises is what we're going to get. And if we look at something like high yield bonds, most of them turn out to be pretty good, right? But some of them flame out. And we do, to account for that, we get a higher expected value here. And if we look over here at investment B, this might be something like stocks, which on average do better than bonds, high yield bonds or treasuries, but we can lose a lot of money with those stocks. So we're always going to look at the spread as well as the expected value, and always more spread equals more risk. And then we spent a little bit of time talking about upside and downside risk, and we said that with the normal distribution, we've got something like this, but in the real world, we may have something like this. This would be a portfolio of the spiders and some puts, which would help mitigate our downside. So the good way to measure risk is to look at this left tail, everything in blue over here. Why? Because we care more about our downside losses here than anything else, right? Unless you don't care about losing all your money, which is very rare. So if we look at our left side distribution, where it's always going to work whether we have a symmetrically distributed set of returns or not, if we have a portfolio with some puts in it or something. So what are our measures of downside risk? Really anything you can think of that makes sense. Something like the probability that our return will be less than zero. I've worked with companies where the probability, we want to check the probability that we're going to lose $20,000 or more on this project, because if we lose $20,000 or more, the startup company is going bankrupt, something like that. Also, we did look a lot, and we do in further chapters, at value at risk. And value at risk is that quantity X where there's a 5% probability at return will be less than or equal to X. And any other or less or worse measures we could think about. We talked a little bit about volatility drag. Volatility drag was important for us whenever we're looking at holding investments over multiple compound periods. So we're not buying, holding for a year and selling. We're buying and we're holding for 5 years and selling. And whenever we are doing that, we want to measure our performance not by the average annual return, but by the growth of the investment over the life of the project. And we looked at a very simple but very telling example of that. So let's say, and this actually comes from a real world example, kind of simplified, you want to invest some money now for your child's college expenses in 5 years, and you're considering 2 ETFs, which one is best? And if you just thought, hey, all I really care about here is my average return, and B is clearly better, it's got a higher average return, that would be so wrong. And the reason is because the volatility of B is going to hurt you. So what you really want to look at is the value of A versus the value of B. So we start out with each one with 100,000, and then A just grows, we get that 3% return. B goes down because it has a minus 15% return. So we're left with 85,000 at the end of year one, and et cetera, et cetera, et cetera. And we just keep measuring how much money is in our account for our kids' education at the end of the year. And you can see that slow and steady wins the race here with A, because it doesn't have any volatility. The pile of money we end up with at the end of the day with A is bigger, okay? And you might want to measure with something like this the total return, which would be the pile of money you wind up with minus the pile of money you started with, quantity divided by the pile of money you started with. And you can see using that measure, A is clearly better than B. Why? Because it's got less volatility as measured by standard deviation, less volatility drag. And we looked at a graph of this, which illustrates really well what's going on. Because of this volatility, we're being dragged down with the B investment, and we just can't catch up. We just don't have time to catch up. And the other thing that was interesting about this is that the total project return, that 5-year project return, is completely path dependent. If we reverse the sequence of years, then B would have looked better than A. So to analyze these volatility drag carefully, we have to use methods beyond the scope of this class called Monte Carlo simulation. Okay, so that was pretty much what we covered in 13A.